Hello, everyone. Happy Friday and welcome to the final bar. Today, we're going to talk about a market weakening going into the limping into the weekend days, of how I would describe it. Nice little bounce into the close, but the damage is done with the S&P down about 1.25%. So overall, this is turning our trend following models bullish to bearish this week from Friday to Friday. So we're going to look at the long term and the medium term and the short term models, how they've evolved. Also look at some key moves in stocks and fixed income. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together through the charts, through the lenses of technical analysis, behavioral finance, investor sentiment, psychology, breadth, whatever we can do to try to make sense of, try to make things as certain as possible in an uncertain environment. As we talked about, the market's certainly weakening through the course this week. All in, I didn't look at the actual numbers to see how we finished this week, but it certainly felt like one of the more painful weeks we've seen. I think part of it is the uncertainty. Obviously, there's a lot of potential headwinds here with the elections coming up, with COVID-19 issues and economy growing by the numbers. But I feel like everyone's day-to-day experiences are starting to get a little more challenging here, with things starting to close off a little bit, and then a ton of earnings providing a lot of weight on a lot of stocks. Stocks like Twitter's down double digits doesn't help. Now we have some great guests on this show. We had some wonderful guests this week, sort of breaking things down. Dana Lyons, we're going to talk about his comments in our mailbag segment. Someone asked about growth indexes, so I'll share with you some thoughts there. But next week, we have three wonderful guests for you. On Tuesday, we have Julius DeKempener, founder of RRG Research and host of Sector Spotlight. On Wednesday, Frank Capilleri from Instanet. On Thursday, Mark Ungewitter from Charter Trust. And on top of that, Monday, as we do every week, we'll hit the market from three directions: top-down macro, sector rotation, bottom-up stock picking, and then we'll wrap the week on Friday. As a reminder, we've had some really good specials recently that are really timely, very topical. A couple that I'll highlight: with Larry Williams did a fantastic special for us last week on the election season. That's on our YouTube channel. Also on our YouTube channel, we did a presidential cycle panel. I hosted a conversation with Tom McClellan, Bruce Frazier, and Jeff Hirsch. That's on our YouTube channel as well. And then finally, we had the pitch just this week as well. It was a really cool conversation. Grayson Rose hosted a lively debate with Mark Newton and Aaron Swenlin and John Kosar from Asbury Research. Really, really well done, and a lot of great ideas that came out of that conversation. So check all that out on our YouTube channel. We'll be replaying them on StockCharts TV as well. Let's get to our market recap. I want to start with a poll. I was going to say, I remember seeing something about growth indexes. It was in our poll. We asked you, which of these four baskets do you think performs the best through year-end 2020? And I sort of gave you the four main sort of style boxes: smaller, large cap, and growth versus value. Over half of you answered large cap growth. Second was small cap growth. Third was large cap value. Fourth was small cap value. What's interesting about that is a number of things. The large cap growth rate getting killed, especially today, right? These big growthy FANG names are the ones that are dropping pretty heavily today. Everything's down. Don't get me wrong. It's been a tough week all around, but that large cap growth rate is really what we've talked about getting us here. And all of a sudden it's starting to suffer. There have been days when the small cap value, out of the 9, Morningstar style boxes, the small cap value ETF has been the best of the 9. So it's interesting to see that happen. So, 3/4 of you are saying the growth trade is alive and well. Let's stick with that. I wanted to mention that because my conversation with Dana Lyons from the Lion Share Report yesterday, he brought a chart of mid-cap growth and small-cap growth and talked about how there was that, basically, if you look at the peak in 2018 and line that up with where we've pulled back to, it's actually a very, almost a similar level. So just as S&P 3200 might be a key level, he was seeing that as a good inflection point as well. So for those of you that are thinking small cap growth, you might want to look at the video. My conversation with Dana Lyons yesterday might help you feel good about that approach. Our market recap is as such. The S&P down to 3270. That was a lot of that, rally came in the last 30 minutes. Before then, we were really at the lows of the day, so saved a little bit of ground. But overall, finishing net negative for sure. Nasdaq 100, the Nasdaq Composite down significantly, with the Nasdaq 100 down 2.6%, and obviously a lot of big names in there: Apple, Facebook, Twitter, all coming down pretty strong today, and that's dragging the Nasdaq down with it. The VIX almost to the 40 spot here. Finished around just below 38. Looking at some other asset classes, bonds are actually an interesting one, breaking down through their 200-day moving average. 10-year yields actually breaking above its 200-day moving average for the first time in a long time. The 10-year yield's now at 86 basis points. The dollar really finished flat, but one of the few things sort of positive on the day. Looking at commodities, the other area that was positive were precious metals, natural gas. These were up pretty good. The commodity complex flat, because oil is a pretty big weight, and that was down. But overall, you had gold and silver up. Let's look at a chart of the S&P. We'll look at some of those other asset classes if we can, and then we'll finish things up. So we were very close to sort of closing within that 3,200 to 3,250 range. We traded down into it. That rally going into the close finished up about halfway up today's price bar, but still, lower than yesterday, finishing, at the lower part of the range this week. So we are certainly within the rounding error of the lows from September. And as we've talked about a number of times in recent weeks and really in recent months after this the sell-off, this peak in June became the low in July, that became the low in September. We're right in that area now. So I think the bullish idea here, if you're bulled up, is thinking this is a lot of great charts at a discount, a lot of good companies at a discount. Stocks have pulled back significantly. This means you can get in at a much cheaper fill than you would have gotten a couple weeks ago. We're 300 points lower in the S&P. That's incredibly tempting, especially if you have a long-term appreciation in mind for equities in general. So we're right at that point where, if you're bullish, I think we need to find support. We start breaking below 3,200, making a new swing low. That would complete a lower high, a lower low. All of a sudden, this feels a lot less constructive for long-term appreciation, I would argue, because we've now broken support. And I think if we break below 3,200, I wouldn't be surprised if we see a bit of an acceleration in selling. So I think a lot of people are kind of waiting on there, maybe nibbling a little bit now. And as long as that holds, we're going to feel pretty good about getting good charts and good companies at a bargain. We're going to look at a lot of the charts. If we look at individual stocks, and on Monday we'll get into a lot more of them, obviously. You're going to find a lot of these are long-term uptrends and pulling back to the 50-day, pulling back to key support levels, has not yet broken the September lows. And a lot of these could be setting up as, we maybe look back and see this as the ideal entry point. For me, though, I don't tend to like buying charts that are going down, just like I don't like selling them when they're going up. I'd much rather see some sort of confirmation, see some sort of buying coming in, show that people are willing to pay a little more than they were in recent days to feel that there's enough accumulation to expect further upside. Looking at some other asset classes just very quickly, because a lot of things sort of in flux right now. I mentioned bonds. We'll look at the TLT here. So we highlighted this last week, actually, when the TLT broke down through its 200-day moving average for the first time in over 2 years, and that's pretty telling. That shows you this rotation. This completes this rotation from accumulation phase, from bullish phase in bond prices, to a sideways choppy environment for much of 2020, especially the second and third quarters. And now this rotation lower. Now we have a clear pattern of lower highs, lower lows. That pattern keeps merging. And now we're below the Fibonacci resistance. We sort of are unable to overtake that. We sort of retested the 200-day from below now and breaking lower. So I think TLT, I could see that heading to 150. That would be my next downside objective. And certainly there's room for it to go a lot weaker than that. You compare that with what we're seeing on 10-year yields. We can look at this. This is the $ TNX. That's the CBOE 10-year yield index. We have another one that tracks 10-year yield as well. Here you can see we're back above 86 basis points, which is 0.86% for the 10-year. So now closing above its 200-day now, following through for the first time since, back here on the left side, we're at the end of 2018. I actually drew this on back here where it's kind of coming up. It looks like we were falling off a cliff and certainly accelerated to the downside here. I've always, I've repeated the catchphrase I heard early on: never confuse the bottom of the page with support. And just because things have gone down a lot doesn't mean they can't go down a lot further. That gave me the confidence that we could go a lot further down in yields. Now, all of a sudden, we're breaking higher. We have higher highs, higher lows in yields. And I think there's plenty of upside for 10-year yields. Obviously, right? I mean, there's much higher interest rates can go, and the curve can certainly fluctuate and make that possible. But certainly seeing bonds break down as yields are going higher. We mentioned gold a little bit yesterday, so I just want to revisit it very quickly because the gold chart hanging in there and closing above yesterday, but still really in this midpoint. We've had a narrowing of volatility. The overarching pattern seems to be lower lows, but we've sort of come up and hung up a little bit. So I think breaking down through this last support from September, following through with a break below the 61.8% level. I think that's the downside risk at this point to a long idea. As long as we hold that, you can see this turning. We break down through that, I think you really have to brace for further downside on gold prices. And you can see that the RSI bottomed out at this point around 40, which is sort of right at that point. So, the chart of gold is similar to the chart of the S&P, to be honest with you, in that it's at the lower end of a range that's valid. If it were to bottom, this is about when you'd expect it, right? The RSI is at the pullback point, still within a bullish range. The price hasn't broken down yet through its September low, but overall, it certainly feels heavier than lighter when you look at the action and just the fact that these high prices keep getting lower. We're really not making up a ton of ground on the upside, and never broke above this Fibonacci resistance, which was in line with support here. So that certainly seems like an important level around 180. And until we break above that, it's hard for me to think gold is a great upside play. If we break that, though, I think that opens the door to much, to further upside for sure. Very quickly, let's touch on some other themes we can get through just in a couple minutes. Looking at sectors, you can see that energy was the number one out of the 11 sectors, followed by financials and healthcare. On the downside, not surprisingly, you have technology, consumer discretionary, and communication services. So you really have this binary sort of look today with those three sectors really weighing hard on the index. This is that large cap growth trade we talked about. And again, this could be a capitulation of sorts as things, a puking out to the lows where you want to accumulate. Again, there's an idea for that, and I get it. And for me, that's fine as long. This is a time when I would think stops are a really good idea, because I think there's the potential at the very least a non-zero probability that we go materially lower. So watching for those sorts of moves and key breakdowns would be important. Let's finish off looking at the Mindful Investor live chart list. I want to hit on some of the other asset classes this time. Well, let's get to the rest of the list, as many as we can get through. So number one, the S&P market trend, certainly rotating lower, and now we've locked in a sell signal from the medium term time frame. That's the first time it's been negative since back here in early May. It turned positive after the April lows, or after the March low, accelerating higher. The last sell signal we got was here in February, and this isn't to indicate or suggest that we have a repeat of what we saw here, but it does tell you the trend is aiming more negative than positive. And again, for me, that is one data point among many. That's something I would look at along a lot of other data points, but important to know that sell signal was triggered today. Short term also negative. That's just below the 5-week exponential moving average. That's sort of my holding pattern, or my placeholder for a short term read. The daily chart's really the main way I would look at the short term, which we'll get to in a moment. And then the long term still very positive, which is absolutely right. We're not far enough off of the all-time highs to think anything differently. We've talked about the daily chart, and again, 3,200, we're right in that range. I think we're in that rounding era where we could find support. It is fascinating to me. It's just poetic that we're hitting this area right leading up to the elections. We've got one trading day on Monday, and then we have election day when we start to see the result. And obviously, we won't hear any definite results until after the close of trading, but certainly top of everyone's mind. So I wouldn't be surprised if we sort of chop around here to see what sort of events happen next week. And I think it's going to be very telling stretch there. In terms of breadth, it concerns me back here in early October when the breakouts in S&P large cap and mid cap breadth were not confirmed by the New York Stock Exchange, and the small cap breadth. Now the price has reacted the way I would expect, given the lack of breadth confirmation. Now all four of these, I'll color code these back to orange this weekend when I go through the charts. I see them all as neutral now. I think you'd have to break down through these swing lows from late September to confirm a downtrend, just like the S&P would need to break 3,200. We need to break those for me to turn more bearish in terms of thinking about downside potential from here. At this point, I feel like it's relatively limited, just given the range that we've been in. We are seeing a bit of an increase in new lows, but not enough. I mean, it's not a ton. And certainly not the number of new lows that we had back here in February. That's absolutely right. Leading into the February high, you can see how we had a lot more new lows, especially in the New York Stock Exchange. We at least had a number, a non-zero number there to pay attention to. We haven't had that yet. Again, the acceleration really didn't happen until we came off, and here we were coming off of all-time highs. This is a little different because we've been chopping around for a little bit. I wouldn't be surprised if the S&P breaks below 3,200. You see these red bars start to increase pretty quickly because you'll see a lot of stocks coming off and starting to test those. But the problem is we're so far away from our 52-week low for a lot of names. That's going to be we'd have to go down a lot to get to that level. So I don't think the indicator is going to have its same impact that it might have back then. This is an important chart, and Walter Deemer kindly tweeted out earlier my take on this. And if at least half of the S&P 500 remain above their 200-day moving average, I'm going to feel okay about the overall market condition in terms of breadth support for an uptrend. If we break below 50%, that is certainly way more characteristic of bear phases than bull phases, and I will start to get a lot. You'll hear my voice get a little more negative than it has been. We talked about sentiment yesterday, so I don't want to kill it too much. I think we did. If not, it's interesting to note 35.3% respondents bullish and the exact same number bearish. It's the first time it's been exactly flat between the two in a long time. It really drives home the indecision that I think we're seeing on there. Final thing, I would just say, listen, there are pockets of groups that are doing well. The relative strength of semiconductors comes to mind as something that's still holding up very well. If you look at the individual names right now, there are stocks breaking out to new highs. There are stocks, many breaking to new swing lows. I think this is more than ever a really good time to scan, especially on a day like today and a week like this. Look for stocks that were able to improve in their scooter rankings. Look for stocks that are able to make new 13-week highs. That's the list I would be focusing on if you're looking for new equity ideas. We need to take a quick break. We'll be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So good to have you joining us every weekday after the close as we look at the charts together. I hope this is a helpful use of your time, and I believe it is. From what we've heard from many of you, you guys have shared some great feedback on how we can make the show better, things we're doing that you appreciate, and we really value that. But we most value your questions that you're running into. And let's open the Final Bar mailbag and see what we can answer from things that have come up for all of you in the last day or two. Question number one, David, looks like the February high of around 33.93 is an important support level now. This is slightly below the 50-day moving average. Do you consider either one more important level to hold than the other? I think you're talking about this, and you're saying 33.93, the February high here. Yep, so I got this orange line that kind of shows that, and you were saying this is an important level, also the 50-day. Yeah, so absolutely right. And so if you look, I routinely go and try to clean off my daily chart because and this is something I picked up from one of my analysts, Mark Dibble at Fidelity. His charts had a ton of lines on it, and I originally thought that was way too busy, but I realized as I worked with him, he was keeping a running tally of just all the important things he was seeing. He would draw a lot of little trend lines on the chart to kind of keep notes of stuff, and I got used to doing that. It was really helpful to just, the annotations remind me what levels were important, and I can usually see where I drew them and at times decide that's no longer important to take it off. I think that's a fair level to look at, and this is why I have that line on there. I actually drew this earlier today. I extended that Fibonacci level over just to see where it's at. And it's right around that 50-day moving average. And I think you've hit on what is really important, which I think is looking at a confluence of levels. When you look at the two of them together and the fact that they're very similar, these are really close to being within a dollar, a point of each other, S&P point or 10 points at the most. And so that range. I usually, if you hear about it, I rarely have specific lines. It's usually more these shaded areas. The reason I do that is because when we moved to decimalization, excuse me, and when I started in 2000, they're just kind of completing that transition to decimalization. It was a lot about, I think immediately levels did not become exact as much as they were before when you're trading on an eighth, and you could logically assume or reasonably assume you'd hit the exact same price point. Now I think of more in ranges, and that's what I've tended to highlight. So I think that range that you've keyed in on is totally valid. It's the upper end of this purple shaded area, the purple haze, if you will, that we've talked about before. Next question, the mindful 6 is interesting, but please show us the chart settings. Yeah, sure. So let's see if we go to how quickly can I find that? The mindful 6. Here is the chart. So yeah, the way you do a chart like this is actually a really cool chart type to make, which is stacking a bunch of them. Now you're limited. You can only do 10 tickers on one chart. But again, I would argue if you have more than 10 things, you need to have other chart. Like that's too much to put on one thing anyways. So it's a reasonable limitation, but 10 is your limit. So the way you do it is you run a chart on whatever you want that first ticker. So I have the S&P up here on top. And then below there, you use an indicator called price. And then you just put the tickers in there. And this can be anything. It can be a ratio. You can do whatever you want. And then I put overlays, simple moving average 200. The other way you make it look so it's kind of this consistent height is here. There's a column called height. It kind of defaults to an auto, which is kind of a 0.5, and you can make it smaller or larger. So 1.0 means essentially it's going to be the same height as the price section on top. So I did the S&P, and then I added these 6 tickers using the price indicator, made the height 1, added a simple moving average, and you're done. If you want that chart, if what I just said completely confuses you, shoot me an email, thefinalbar@stockcharts.com. Be clear on what particular chart you're looking for. I can click here on permalink and send you the link over email. I'm happy to do it. The next question, I notice you refer to the price, RSI, and price relative to a benchmark. Do you use the MACD? And if so, when? Is it redundant for you because you process the info directly from the 50 and 200-day simple moving averages, saving valuable chart space? So yeah, I mean, you can see sort of the default chart, and the way I think of it, you got to have something you start with, and for me, it's the price, the moving averages, the RSI, and the relative strength. That combination is what I've used for years and years. I'm so used to looking at that thing. You probably have your own chart style, and that's totally fine. You should, and that should be whatever makes sense for you. If you want to, if someone asks you, what do you think of X? What do you want to have on that chart to make a quick assessment? So what I've always thought of. If I was going to add one more indicator, I'd probably do the PPO, which is like the MACD, but it's based on percentages instead of price. So the MACD is moving averages based on the price differential. The PPO, percent price oscillator, is the same as MACD. It's just calculated off the percents. So it's a little easier, a little more apples to apples, a little better gauge of trend, I found. So, but either of them are fine, and that would be the next one I would add if I had room for it. A lot of times on the weekly chart, I might actually have my default weekly chart. I rarely bring it up on here, but I do when I'm talking with clients. Yeah, here you can see it's the price, the PPO. The price, the RSI, and then the weekly PPO on the bottom. So I think that's totally valid. And if I was really just focusing on swing trading, I would use some version of PPO for sure. Next question, et cetera, et cetera. Let's see, the continuity question on your SPY weekly chart. You're talking about this one. You use EMAs 5, 21, and 34. That's up here on the top, and that's right. For the PPOs, you use 1, 5, 0, 12, 26, and 9, and 21, 34, and 0. Wouldn't the use of the standard 12, 26, and 9 PPO suggest that you use the 26 rather than the 21 EMA? That is a really deep and thoughtful and really well thought out question, and thanks for that. So if you miss that, so I have the 3 exponential averages that pretty much are how most of these are calculated. And so it's the 5-week, which is the short-term gauge, and then the 21 and 34 are the long-term gauge. And this main PPO, this weekly, long-term PPO, is the difference between these two 21 and 34-week exponential averages. The short-term indicator is based on the difference between the price and the 5-week exponential moving average. That's here in blue. Here in the middle, what I use is basically Jerry Apple, who created the MACD indicator, did a bunch of testing when he designed it and came up with 12, 26, and 9 as the standard setting. And so I found a lot of investors stick with that, and that's why I find it's really helpful to use. I haven't found any combination to be materially better than that on that time frame that would make me want to change it. The reason I picked 5 and 21 and 34, they're Fibonacci numbers, and my approach with things like that is sort of something I probably picked up from Tom DeMark more than anyone, where his indicators would usually start with some combination of Fibonacci numbers and then kind of go from there if something worked better than otherwise. And that's kind of what worked for me. So I could use 13 and 21 and something, and that would be more poetic for Fibonacci retracements, but this has worked pretty well for me, so that's why I use it. Fair question, though. How do you draw a geometric figure on the chart so that shows as it has a color, but at the same time, it doesn't block the candles view? I do it on my daily chart. Yeah, you're talking about these areas. This is an Arthur Hill trick. He showed me this when I first started using StockCharts seriously, and I really appreciate it. Here's what you do. You go to annotate. You go to this little guy. You draw something that you want. It's going to be this solid color. Click up here in the color area, and then just make the transparency a little lighter. And he would do that. And I was like, that's a great way of just highlighting a key area, so instead of, doing a circle or something, it's just a nice way to sort of capture that. And so that's the trick. Not too hard to do, actually, once you get familiar with it. The very last question, then we have to wrap here. I know you rate sentiment behind price and momentum in terms of importance. And you're right. I sort of go 3 steps: price, breadth, momentum. That's the order of operations. So thanks for hearing that. That's good. I've seen people mention on Twitter a sentiment indicator called the Daily Sentiment Index. I don't see it on StockCharts. You're absolutely right. So yeah, we do have a series of sentiment indicators, things like put call ratios, the AAII survey, the name exposure index. We have another one called, I think it's !FF bull and bear. That's from wallstreetsentiment.com. There are a lot of different ways of measuring sentiment. The one you're calling the Daily Sentiment Index, that's actually one, if I remember right, if I know it, it's Jake Bernstein created this, and it's I think it started really with futures, but I think he runs in on a bunch of different things. And it's as far as I know, it's a survey that's run to get daily sentiment readings on all these things. Most of the sentiment you get is weekly, so it doesn't change as much. It's not something we have. It's something you like. Do me a favor, send a note into our support desk and request it. The more requests we get for something like that, the more likely we'll be able to add it. But we're always looking for breadth and sentiment measures to add to the platform. That is our mailbag. Thank you all so much for those questions. It all came from you in the last day or two, and really appreciate hearing from you. We need to wrap the show, wrap the week, and go to the 3 and 3 charts in 3 minutes. Here we go. The bullish percent index is chart number 1. It's $BPSPX. If you don't know what I'm talking about, go to our market overview page, our market summary page. You'll see the market, bullish percent index is listed out. Look to our Chart School article on bullish percents to see what this actually represents. But it basically means what percent of the S&P are in bullish signals, buy signals, using point and figure charts, using the traditional point and figure setting. Right now, just below 50% are in a positive, which means over 50% are now in a sell signal. Does that mean the market's going to go materially lower? And the answer is maybe and maybe not. If you look back through the last 6 months, you will see that these sell signals, quote unquote, when it had a bear confirmed signal below 50%, that is what happened here in May. That's what happened in late June. That's what happened in late September, which is why I think this is so key. Just like the S&P is hitting 3,200 and we're right back at those levels, we're at a similar pullback level to where previous swing lows that were buyable ended up evolving. But this is also what happens just before the market goes materially lower, and we've seen that in a number of places as well. So this is why it validates to me the importance of S&P 3,200. I think if we go below there, I think you'll see the bullish percent continue to drop, and I think that will tell you to brace for potential further downside. Now, one of the main things we saw going to chart number 2 in terms of suggesting that the October peak in the earlier in the month was questionable was the fact that you had bearish divergences in a lot of consumer and technology names. This is McDonald's with the higher peak in mid-October to the September peak, and a lower peak in RSI. What's happened since then is now we've broken down. We're really close to breaking down. I would argue we have, having gone through the 50-day and now confirmed a couple days lower, going below the closes from late September. I think stocks like McDonald's are already breaking down. And so a bearish divergence with a breakdown in price at the midpoint is a little more negative. What also concerns me, thinking about S&P 3,200 and its staying power, stocks like Visa, MasterCard have already broken down. Visa's down below its first Fibonacci support, also the swing low, also the 200-day, which to me measured down to around 165. So I think some stocks are already telling us to brace for lower lows. Folks, that is our week this week. Thank you so much for joining us every weekday. Catch all of our previous episodes and interviews on our YouTube channel. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Happy Halloween. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.